Will the market pick a direction? Welcome to the Real Vision Daily Briefing. It's Thursday, October 20, 2022. I'm Ash Bennington, joined today by Tommy Thornton, founder of hedge fund Telemetry. Quick reminder, our live chat function on the Real Vision site is temporarily down, so please drop your questions in the comments section on the Real Vision website or in the live chat on YouTube, or tweet to us directly at Real Vision. By the way, we now have a word from our sponsors, or to be more precise, Ral and Damien. They want you to know what you see in the daily briefing is just a fraction of what you get when you subscribe to Real Vision. We believe that the next 3 months could define what happens in the economy over the next 3 years, which is why we've just launched the hugely popular Make or Break series. This is quite simply essential viewing. If you want to protect your wealth or find the hidden opportunities in the months ahead, an annual subscription is now just $99. All right, I think that will make Ral happy, so let's get back to it. Tommy, welcome back to the show.
Thanks for having me. Nice to see you. Kind of a wild time in the market right now.
It sure is. It's a great day to have you on. Tommy, I've been off in crypto land all day. What are you looking at? What are your big stories?
Crypto land.
Yes, it still exists.
It's like on the moon, it's like Capricorn 1. It's not really there, but anyway, I don't believe in the moon landing. No, I'm just kidding. So the markets are chopping around, and I think the turbulence has been, you see these like little short-term 5%, 6% bounces, and the bounces are getting shorter every time, and they're steep and drop off real quick. But what's been really nasty is the intraday action, where you see these gap ups and then they fade and they close underneath the open, and it's just trapping a lot of traders in there, and it's just like a bully's on the playground just punching you. It's just really tough for traders. So my view is just, and it has been, I've been very tactical all year. I've kept a very high cash percentage. I've preached caution continuously, looking for ideas on both the long and short side, but you've got to keep your size down. And I've been, buying things or selling, shorting things at moderate, exposure. I'm actually very, I'm set up very neutral right now in my exposure, but I am max short my size limit for SPY and Qs. So we'll see how that goes, and it all can change tomorrow. I'm not stuck in cement on any positions.
Well, let's talk about SPY. Let's talk about more broadly the S&P 500. Looks like off about 0.8%, closing out the day at 3,665. As you said, some chop in that. What's your take? What's your interpretation?
Well, we have next week the meat of the market reporting. You have all the mega cap names reporting, and it's going to be just an absolute week where you might need a helmet a couple days, and you could see some really strong rips higher, depending on what the market interprets with some of the earnings. I mean, you saw Netflix had a really strong report. I saw a lot of holes in the report, but the market chased it. Not that many people were short Netflix, so I think it was more of a exposure chase on the long side. I'm not sure how long that's going to last. You saw Tesla report, and their earnings were sort of squishy, not great, not wonderful. And in the past, if they came out with inline,
and they lowered their full year growth expectation as well.
Tesla. Well, I mean, not by much, not by as much as I think they're going to need to lower their expectations. But the market used to reward them, even whatever they reported, the stock would go up. And now it's starting to fade, and people are nervous about Elon selling stock to buy Twitter, which I think is possible. So that's that. We can talk a little bit more about Tesla in a while.
Yeah, absolutely. We can focus in on that, but let's also talk more about the broader sort of macro setup that we see here right now. I mean, the thing that I've been looking at here going into this is I'm looking at right now the 5-year chart on the U.S. 10-year Treasury. Pretty stunning when you think about the rate of change in terms of the 10-year Treasury yield rising.
Yeah, I'm not sure if that was the right chart. I don't know. Maybe I wasn't looking at it. Yeah, we're, a lot of people just keep wanting to buy bonds, and I'll take a little stab at bonds every once in a while and, reverse my course quickly. I've traded bonds pretty well. I was very, very negative with bonds when yields were, really, really low. I remember when the 2-year crossed 20 basis points, I said, "Uh-oh, this is going to really take off." And now it's at 4.5%. It just 4.6%. It's just been insane. There's a lot of carnage out there in the bond market, and I'm not quite sure that it's done. And partly because you have a lot of sovereign governments and large corporations that are selling bonds and buying dollars, and that's why the dollar keeps its strength as well. So it's been really one trade. It's been long dollars, short bonds, short stocks. Look at the yen. I mean, this is the breaking point. I think it's going to be the breaking point in the market. The yen continues to decline versus the USD. It's at 150. They have Japan CPI tonight. I think there's going to be a lot of pressure on the Bank of Japan, and just stay near your phones and see what happens.
Yeah, we'll talk more about that in a second, but I just want to double click on the point that you just made. 10-year U.S. Treasury yield right now at 4.23. 2-year U.S. Treasury 4.61. Long story short, 2's10 spread right now getting close to 40 basis points, minus 3.8, almost negative 40 basis points, negative 0.38 right now.
Yeah, the real thing that I'm going to watch is when the curve starts to narrow, or excuse me, when it starts to widen, steepen. I think that's quite possible in a few months, and I'm watching the 2-year really, really closely. We've had exhaustion signals, the DeMark exhaustion signals on the daily time frame with several of the bond proxies. And, one of the things that is very important is when you do not get the reversal as you would expect, or a very nominal type reversal or stalling, it's telling you exactly what this trend is, and it's very, very strong. So I'm not calling any turns in the bond market right now. It could certainly happen at any time, but I just don't see it right now.
You talked about this idea of a curve steepener. Which side do you think is going to move?
I think the 2-year. I think the 2-year is going to decline, or the yield on 2-year is going to decline.
Yield is going to decline. You see prices rising in treasuries at the short end of the curve.
Yeah, short end. I mean, and that's sort of a fluid. I don't want to go in stone on that, but that's a little that's kind of where I see. That's where I see it happening.
And what are the drivers on that, Tommy?
It's a good point. Look, maybe the Fed, and I'm not a Fed pivot person at all, but I could see if, let's say, the equity market falls to 3,000, my target is around 2950. Not necessarily on this leg down. It could happen. It could happen very quickly. Not saying crash, but it could crash. But you could see the Fed moderate their hikes, and they may just say, let's go 25 or 50 basis points. It's a low probability at this point, but that is where I see the bond market making a big turn.
Meaning
that may not happen.
You could see the hawkishness diminishing at the margin, going from the price in of 75 basis points down to 50 or maybe even 25 if you start seeing more carnage in asset pricing.
You're really going to need some sort of snap in the market for that to happen. So that's a low probability right now,
right?
But anything is really possible. Look, we've just been at new lows on the S&P last week, and if we break those next week with the big mega cap names, anything is possible. Look, I think the Fed's inflation target at 2% is going to be very, very difficult. You've got very, very sticky inflation metrics, especially with owner equivalent rent it's very hard to turn that. I don't see that going down for a few more months. And that's the problem that they have. You can't pinpoint and be surgical about controlling inflation without really breaking everything in the economy and
Right.
sending the economy into a recession.
Yeah, that's very well said. It's almost the opposite of surgical. It's a carpet bombing approach. It's really the only
Yeah,
way to do it at this point.
yeah. And look, you haven't seen employment go up. You're still at 3.5%, and I think the Fed is not going to necessarily blink until you're over 5%, and that's even still historically, very, very low level.
You're,
And the
you're talking about the
problem
you're
that
talking about the U3 rate here on unemployment.
Yeah, U3. And the problem I see is also when we've had a rise in the unemployment rate, it's not a 6 month thing. It is a 12 plus month type of move. The pandemic was a little special and different, and I don't think we're going to have that type of move, obviously. But I think that's a risk. I mean, in going back in history, Volcker, his pivot was long after, almost over a year after inflation and the CPI peaked, and unemployment was still going up, and it was going up over 10%, and that's when he pivoted. I'm not sure that this Fed can do that. I'm not sure what the equity and bond markets would look like if that was the case.
Yeah, and I think it's also probably fair to point out that the economy was less financialized then, and you saw less of an intense correlation between the S&P 500, for example, and labor markets. But and I don't want to sort of make this more grim than you intended, but it really sounds like what you're talking about here is this notion that the Fed is simply just not going to be able to steer a sort of middle course between the risks of inflation and the risks of recession.
They can't just go and raise rates, and that's going to lower food prices or energy prices. And the thing that I worry about, and I'm actually bullish on energy, and in that last dip, I bought energy stocks, and which have worked really pretty well. I still want to buy them on dips though, because I think that the Biden administration, they're being, they're talking about buying back crude at lower levels, and they're giving prices of those lower levels. And I think it's very clear that they're going to most likely start replenishing the SPR after the election. And it's, of course, not politically minded, as they said, but I think that it's just so transparent. But that's a great opportunity, I think. And that'll probably keep the inflation numbers elevated somewhat going into next year.
Let me just touch on one other point, which is earlier today, looking at the Bloomberg terminal, the top news story here, and literally the first paragraph is this idea that interest rate swaps right now are pricing a 5% peak, I think slightly above 5% when you look at the WERP function for the policy rate in 2023. That suggests that the Fed is going to stay its course, at least in the view of those participants in the swap market. I'm looking at right now the implied probability. It looks like it peaks. It looks like it peaks around May of 2023 at just over 5%.
I think Jeff Gundlach said it really well. Why do they even have the Fed funds rate when they can just follow the 2-year, and the 2-year at 460, I think is indicative of where the Fed funds rate is going to go, and they're behind the curve if you look at the 2-year. And I think 4.5 to 5% is where they're going to have to get to on the Fed funds rate. So I'm looking over here. I always like to look at some of the after-hours stuff, and we've always had some comical stuff with the GME stuff way back when that was going nuts. But it looks like Snapchat is snapping again. It's down 18% after hours. I don't know what their earnings are like, but I'm going to guess they're not so good. And Snap had a 23% implied move. That's huge.
Based on the derivatives.
In the option market, that's a huge move. And it lived up to its name, or to its implied move. So that was the bellwether earlier in the year when they guided down and everybody freaked out that the online advertising model was breaking, and I guess it's still broken.
Well, that's really the key point, Tommy, is why is this significant? And I think it's precisely that. And I think you and I were actually online when the numbers were released after hours, however many quarters ago that was. And folks were reading that as some sort of, and we actually saw, I believe, NASDAQ Composite, NASDAQ 100 get whacked the next day. The futures get whacked in the after hour session. We essentially saw that being taken as a bellwether, exactly as you said, for the health of the overall online advertising business, which is obviously
Yeah.
the model that Facebook and Google rely on.
And Twitter. And Twitter.
Twitter.
And I'll tell you, 44 billion, that's what a deal for the shareholders of Twitter. And, look, I think there are some people out there that think that if Twitter was not being bought, it would be in a teenager price. It would not be in the 20s, or be in a teenager of what it's worth. And, poor Elon. I think he couldn't get his way out of that, and is gonna have a buyer's remorse, and gonna lug that one for a while. And I'm sure his buddies that are financing it with him are thrilled. Thanks, Elon.
Speaking of people who are not thrilled today, I wanted to get to our tweet of the day, which is none other than at Tommy Thornton. Let's take a look at this. So this is no caption, no words. It's just a picture of Liz Truss and a head of lettuce. Tommy, do you want to explain this one?
Well, I'm British heritage, but I'm not a Brit. The papers there are just brutal, and they were saying that a head of lettuce was going to last longer than Liz Truss. And
I think there were odds makers who were actually taking book on this. Right?
There was a live YouTube channel that had a picture of her and this lettuce head, and it's a comedy show there, and it really kind of makes the U.S. political situation look somewhat sane.
Yeah, talking of images associated with the premiership of Ms. Truss, we had a chart queued up. I'm not sure if we can bring it up now. That really tells the story visually, and it begins, whatever number of days it's been since she was a premier. It begins in September. With this is a look basically at what happened to the 10-year gilt yield, and you can see that curve right there, which kind of speaks for itself. And Liz Truss U-turns on taxes, October 14 is the penultimate data point, and the last one, of course, is Truss resigns 20 October. So there it is, the visual image that you can see for where we were with 10-year gilt yields, kind of the bellwether of the premiership of the now former premier Liz Truss.
Well, here's what the way I look at it is the markets dictated how long she was going to be there. It dictated what the Bank of England had to do. And sometimes when you have the most non-volatile, safe type of strategies like LDIs, they're the ones that are going to blow up because leverage is so high in those. And you're not supposed to have these types of extreme moves in the gilt market or the US bond market, but you did, and that's what blew things up. It blew up long-term capital in 1998, where they were picking up nickels with a steamroller or bulldozer, and that snapped and broke, and the leverage was exposed there too. So every big financial disaster revolves around leverage.
Yeah, you're talking about these liability-driven investments, leverage-driven investments, and that obviously is the challenge. By the way, while we're pulling things up on screen, I want you to take a look at a conversation that I had with Christopher Dembick, head of macro analysis at Saxo Bank. This is a conversation called Make or Break Geopolitics. This is a series we have here at Real Vision. Is this the beginning of the European disunion? Out today on the Essential Tier. Let's take a look.
Well, I remember I wrote an analysis, I think it was two months ago, saying that the UK is becoming an emerging market. And I got a lot of mean message on Twitter, especially from British people, telling me that it was a bit offensive. And perhaps it was a bit offensive. But what I want to say is, I would say that the UK economy went through Brexit quite successfully. I mean, it was not a huge success as they were expecting, but you might remember in 2016 that everyone was so gloomy regarding Brexit. They would say that in 2018, 2020, the UK economy will get down by, I don't know, 20% and so on. It has not happened. But what has happened, Brexit actually did not harm so much the UK economy, but this is mostly mismanagement of policy. We have seen, of course, much more recently, but you have also, again, the energy crisis is a huge issue also in the United Kingdom. And I think this might be a little bit polemical, but I think for the UK, this is one of the toughest challenges in it has experienced over the past 60 years, perhaps. The Bank of England expect that recession will last for 15 months. And usually, you know what's going to happen when you have a recession. You have quasi automatically a very strong rebound in GDP. And what is striking, the Bank of England is telling us that in 2025, GDP will still be lower by 1.75% to the level of 2022. So this is a very gloomy economic outlook, I think, for the coming years for the UK, and I would have, of course, very low exposure to British assets.
Well, it starts with the bomb. Well, it starts with the bombshell, Tommy. This idea that the UK is potentially becoming an emerging market. We were talking a little bit off camera about what's happening in the euro area. What are your thoughts there?
Well, one of the problems that you have with the Eurozone is it's not just made up of one country for their central bank. It's made up of all these different countries, and some are richer and some are poor. Some pay more, some pay less, and there could be, discord as far as what the policy should be, because each country could be hit a little harder depending on what the central bank does. And if you want to talk about a central bank that is behind the curve, that's one that has been well behind the curve. And unfortunately, it's such a nasty situation because they have a demand, not a demand, but a supply shock that's affecting inflation. So they need to raise rates in that type of an inflationary period. They're going to have a nasty recession. Their currency's going down, and that's why they need to raise rates ASAP. And so that is a complete possibility. In the old Eurozone crisis, the Greek crisis, 2011, there was talk of the EU breaking up into splitting off. Remember the pigs and all that? Yeah. So it's a little precarious. One thing that I did on Twitter, and I forget when it was, but it was earlier this year. I put a poll out. I said, what central banks concern you the most? Something like that. And I had the Fed, I had the ECB, I had the Bank of Japan, and I put the Bank of England in there. And I had a bunch of people that said, well, why would you put the Bank of England in there? And lo and behold, they blew. And people said, what about China and all that? But the Bank of England. And I guess the Queen, I'm glad she's not watching this debacle, because it's rather embarrassing if my personal opinion of it all.
Yeah. Tom, we talked a little bit while we were at the break about what was happening in Tesla. What are your thoughts there?
So I've been thinking since they came out with their deliveries that were well under consensus estimates, even the consensus estimates that were revised down dramatically ahead of the number that came out. I thought it was just strictly a demand issue, and they blamed logistics and not being able to get car carriers at the right price as their, new excuse. But on DM today, I found a guy hit me up who was their previous car carrier, the head of logistics for the car carrier. He owned this company, and he moved 56,000 Teslas for them, massive operation. And Tesla treated him terribly in the sense that they they didn't pay him on certain times. He, allowed it. He was like, okay, fine, you'll pay me when you pay me. And as it turned out, they rebid the contract, and insiders were able to, underbid it by $50 a truck or whatever, something. And this guy was basically left out. And this guy painted his trucks in Tesla colors, and he tried to give them, guidance as far as how to set up, centers around the country for the logistics and the trucks. And they just shunned him, and they brought in people that were complete inexperience. One guy was an art history teacher. One guy was a, ex-swim coach. One guy ran a restaurant. No experience at all as far as how to manage logistics. So now here's what's happened. They're complaining that it's going to cost a lot more for these carriers because they don't have a carrier company or carriers available. They bought carriers a while back, and they were from an old company that had a big investigation against them. They were rusting, and that turned out to be a real problem for them.
Tell me, I want to just go ahead. I just want to jump in real quick because we've got some questions that are coming in from the audience. I want to have, and we're running out of time, but I want to have at least the opportunity to ask just one. I'm sorry if you wanted to finish up there on Tesla.
No, that's cool. Anyway, it's a disaster there. Yep. End of story.
So this question comes to us from Demo at Walking Tuna. This is from Twitter, and the question is, this is right to the chase. Rates. What's the bond market signaling? Are equities getting set up for another leg down, Tommy?
Yeah, the equity market is a slave to the bond market, and a friend of mine gave me that quote, and I think that's very, very true. And look, there could be a breaking point where rates just go absolutely nuts. And yesterday was the anniversary of the 1987, and rates went nuts into that event as well, and everything snapped. So it's very possible that that's going to be on the horizon, and we have not seen a capitulation at all. So that's
and that implies at least the potential for a setup to the downside on the equities market more broadly.
Yep.
Tommy, here's what I learned today. There are key takeaways. Earnings next week are going to be a wild ride. To quote you, Tommy, you may need a helmet.
I recommend it.
You want to be watching the Japan CPI tonight. BOJ may be in real trouble depending upon the outcome of that data. Long-term structural challenges across the EU in your view, and equity markets is the slave to the bond markets. Rates could go absolutely nuts, implying that there may be some downside volatility in U.S. equities. Does that about cover it, Tommy?
God, I am Mr. Doom and Gloom. Eesh. Oh, no, it won't be that way forever, though.
When I opened up the Bloomberg terminal today, there was a picture. The first thing that came up was a big picture of Nouriel Roubini on my screen, and I was like, "This is doomy times."
Yeah, he is in his element right now.
Yeah,
I like Nouriel. I like Nouriel. It's just once that big nasty event happens, he tends to stick with it too long and hangs out with like supermodels and tries to, he did that the last time. It was just like, come on.
Well, this time he's got a call on for secular stagnation. So a kind of a secular stagflationary setup that's going to be global. And it sounds pretty grim in his view.
Yeah, but here's the other thing. You're really nothing if you don't make a call on the opposite end. There's a lot of people that are perma bears, and they're perma gold or whatever, and they never get the other side right. And I try to find both sides, and sometimes they're a little shorter term in nature, but if you can call the turn, then you've got some gravitas.
Well, that's what we always try to do here, Tom, is look for the both sides of the equation, both sides of the argument. Always a pleasure to be doing this with you. Always enjoy it.
Well, thanks, Ash, and thanks everyone for joining us, and it's always fun.
Thanks again for watching the Real Vision Daily Briefing. We'll be back again tomorrow with Warren Pies. Thanks again for joining us, Tommy. Thank you for watching. Have a great day, everyone.